Hi, everyone. Thank you for joining us today. I'm Marche, the webinar director here at Advice Chaser. Before we introduce our guests and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we're thrilled to bring you this educational presentation. Attendees are muted, but we encourage you to ask questions using the chat box. And Kate, do you want to go ahead and flip to the next slide there? If you have questions during our webinar today, make sure to chat them in the chat box. And if we don't get to them, make sure to leave your phone number as well. We will make sure someone reaches out to you after the event today. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. So I'd love to introduce you to today's presenter, and we've had him several times. I want to welcome you back. Kate Hamas is the owner of Storybook Financial in Coralville, Iowa. He is a certified financial planner and a registered life planner with degrees in accounting and finance from Iowa State University. Leading up to founding Storybook Financial, Cade gained great experience working on financial plans with pre-retirees and successful business owners. He and his wife are the parents of one daughter, and he has been our guest speaker for our Financial Basics series. Good for anyone from a young professional to a millennial to people in their prime working years, and even to people that are pre-retiree or retirees. So this is really great information. And I'm really excited to turn the time over to Cade. Cade, let's get going.
Okay, thank you, Marche, and welcome everybody. Every time she says I'm going to be funny, and so I think I really need to work on that. So anyway, well, welcome. Today's all about understanding risk to your financial plan. As she said, I'm a certified financial planner, and financial planning is my passion. And over time, I see a lot of things where there's the standard risks that are associated with doing financial plans, and the kind of the big low-hanging fruit that's out there that everybody can kind of just be aware of, and just being aware of something allows you to plan for it and hopefully make so it's not as big of a risk. When I talk about risk, it's anything that could see you derail your financial plan, whether it's you want to retire at a certain age, or you want to be able to do world traveling when you retire, whatever it is that's part of your financial plan. I just want to make sure that you know the risks that are out there and that you're doing everything you can to protect yourself. Sometimes you answer those risks by planning for it. If you have enough time, if you're a young professional, she's said, you probably have time to kind of plan for a lot of these risks. Others, you might be a little bit later in the game. It's a little maybe too late to plan for certain risk. And so it's now officially time to do what we call mitigate risk, which means we might use insurance or some other means to try to make the risk essentially go away, or at least minimize how much risk is there. Today, it's a lot about common gaps and pitfalls that I feel everybody should know about. I know this whole conversation could just go 100% around insurance, but I tried really hard to make sure this isn't just an insurance conversation, and make sure that we talk about a lot of things other than just insurance. But we'll cover some of those things in the middle of the presentation. The biggest one that I see time and time again when somebody comes to me for the first time to do a financial plan, and it's almost always somebody late 50s, early 60s, they want to know if they can retire yet. They would have retired yesterday, but they just came to me and they want to know if I can retire. And almost always the problem is we just simply have not saved enough. We know we have Social Security coming, but it's just not enough. And so what happens is if you do not have enough, that means you either have to keep working, which nobody wants to do that. If you're ready to retire, you're ready to retire. You don't want to be told you have to keep working. Or you have to be prepared to cut lifestyle. And I can think of no bigger pain other than having to work longer than having to cut lifestyle. Once you get used to spending money at a certain level, cutting your expenses, it's a very difficult thing to do, and it is not a fun thing to do. If you wait until you are 64 years old and planning to retire at 65 and you have not saved enough and you're going to retire anyway, chances are you're going to have to cut spending a lot. And so if you were planning on taking a trip twice a year in retirement, now all of a sudden you might not be taking a trip at all. You might be cutting expenses with your day-to-day stuff if you hope to retire within a year. So it's just one of those things that I've seen over and over and over. And so I've kind of put some bullet points here of why is it that we just haven't saved enough. A very common one I see is as we focus on the debt. If you have high debt, you have high interest debt, so you have credit cards, almost always the recommendation if you have credit card debt is let's get those paid off before we worried about retirement. Even student loans, some of the higher interest rate student loans, we're going to focus on the student loans before we worry about retirement as much. The issue I see with that is I've seen it, even people working with me, I guide them and we get the debt paid off. And before I can get them saving extra like they were supposed to, all of a sudden we replace that old debt with a new debt. And now we have to fight to replace that old debt and get the old debt paid off. And it just hinders their ability to get to saving. If you plan on focusing on paying off debt, make sure you make the debt go away so that now you can focus on saving for retirement. That's just one of those easy things that maybe it's not as easy I make it sound, but it's one of those things that you can do on your own and try to focus on as you're doing it. Starting too late. Again, it's very much like the debt issue. If you are coming to me in your 20s and you've never saved a dime, you're fine. Like we can save enough before retirement. If you're coming to me in your 30s and your plan looks absolutely terrible, you're spending way too much, and you're not saving anything, chances are it's going to be a minimal amount that you have to sacrifice. If you're coming to me in your 30s, I get you to lower your expenses just a little bit and save just a little bit more than you had. And every raise, we'll try to make sure you're saving a little bit more with each raise. And chances are it's going to be minimal how much you feel from those changes. And it's not as big of a deal. Your 40s, you can still make changes that are positive. 50s, it's getting a little bit harder. If you're coming to me in your 60s and you still haven't saved near enough, it's starting to get a little bit too late. There's not a whole lot the best financial planners can do for you. So it's important to try to start early if you can. The last bullet there was just waiting too long to see if you have enough. If you've never done a financial plan and you are getting, especially if you're in your 50s already, you've never done a financial plan to see if you have enough for retirement, to see if you have enough for your goals and what you hope to achieve after you quit working, now's the time. Go do it. If you're in your 40s, I encourage you to do it. If you're in your 30s, I work a lot with 30-year-olds, even late 20-year-olds, just getting started, making sure they get started off on the right foot. The earlier you can see where you're at and understand your financial plan and what it looks like, the more time and the smaller the adjustments you have to make, and the bigger difference you're going to see them make.
I would just break in here.
Go ahead.
We do have a webinar all about understanding debt with Kate, and that's available on our website at advicechaser.com if you're interested in watching. We do talk all about debt, student loans to credit cards to mortgages. So if you're interested in that, we do have that recording available. All right, go ahead, Kate.
And so on that same note as overspending, and I want you to kind of think of spending as lifestyle. It's just changing. Spending gets a really bad kind of name to it. Really, it's your lifestyle. It's how much do you get to spend? How much do you get to live off of? The bigger your income, the more you get to live off of. It's kind of called escalation. The more you make, the more you spend. And the key is the more you make, you also want to be saving, the more you need to save and the more you want to save, because it's all kind of works together. It allows you to save in the future. So with that note, that first bullet point, forgetting about your future self. Financial planning is all about the balance of current self, future self. We want to make sure that throughout your lifetime, I would like to see you be able to spend more in retirement than you spend today. Not a lot more. We don't want to totally sacrifice today. I still want you to go on vacations every year. I still, if they're part of your plan and you can afford them, not saying everybody, I need to see your plan to make that type of recommendation, but I want to see you going out and having fun, making adventures and living in the house of your dream as soon as you can. Those things I want to see, but we do not want to sacrifice your future version of yourself. We don't want you to get to your 50s. You're used to living in, I'm going to say, a mansion, and you're used to going on multiple vacations of the year. And then you get to retirement age and all of a sudden that all goes away because you've spent everything and you have nothing. You have to live off Social Security. That's not what you want for yourself. So while you're young, make sure you're not overspending. Don't forget about your future self. Not cutting back when changes could be small. That's what I'm saying is early on, things could be just a very small change, and it makes a huge difference if you've got enough years and enough time on your side. So make sure you make those cuts now, so that if you need to, make those cuts now so that you can afford everything in the future. And again, the last one there is adding income, but adding expenses. And that's really the escalation that I was talking about. You know, I've done this for quite a while, and people ask me all the time, what's the average people spend? And I'm going to tell you, it totally depends on how much they make. I have seen somebody in Iowa making, just people in Iowa just making, less than 30,000 a year, and they're living off of basically quite a bit less than that. And sometimes I question how people are able to live off so little, but they make it work. But then I've seen people making up north of 350,000 a year, and they're spending 349,000, right? They're spending every ounce of it. They're not saving anything because they're just used to that escalation. As they make more, they spend more. It's just an excuse to take more vacations, to have a bigger house with more cost and more repairs. And it really can add up. And so it's just making sure as you make more that you're also putting away more, so that when you get to retirement, when you get to financial freedom, you get to live the higher lifestyle that you're used to, that you get to keep living that throughout your life, even after you quit working.
We did have a question here from the audience. Can you suggest some of you said cutting back when changes could be small. So could you maybe mention some small changes that you've seen people do?
Yeah. Trying to think of some of the lifestyle hacks. It's interesting because there's always somewhere in your budget that you could cut, right? I typically don't get super granular with my clients and make them form budgets. If you go out, I think like somewhere like You Need a Budget, or I can't remember the Dave Ramsey budget version, but if you go out and you start actually watching your spending, you'll see how quickly you're spending more, like eating out every night of the week. We were really bad because it's ever since Grubhub and Uber Eats and some of those came into the works. It's so easy as a parent of a young child to just order food out. But then of course, it's not just you're ordering out, they're also tacking on that delivery fee, and you've got the tip, and it's all these costs add up. And it doesn't seem like a big deal if you do it once in a while, but if you continually do it, because we just didn't plan ahead. We didn't plan for what we were eating. And food's just one that it's easy to pick on, because I know so many people eat out way too often. And it's one that we struggle with ourselves. And it might be something like some other spending habit. It could be something with, we're going to talk about insurance next. It could be something like, you got insurance quoted to you years ago, and you never got your insurance requoted ever. I'm telling you that property casualty, almost all the insurance company, like property casualty, they're going to slowly raise your rates up. And if you never get it requoted, you'd be surprised at how expensive they are compared to somebody new quoting it. And it's just because they continually increase it until you go get it checked. And some insurance companies just do better at different ages of your life. Whoever gave you a cheap quote when you were young might not give you a great quote when you're a little bit older or when you have kids or however. Those are just a couple really quick ideas. I don't want to get too bogged down on it, but there's always places in your spending that I'm sure you could cut a little bit if you need to. The other one that I'd mentioned briefly is on the income side. If you need to save more, a very good way to do it is when you get your annual raise. Instead of just automatically spending more, if say you get a 2% raise, try to save an extra 1% of your income. It's because it's income that you're not necessarily used to spending. I know inflation's happening, but you're not necessarily used to spending that much extra. So that's just another little quick tip for you. But I'm going to jump forward to the insurance conversation here. So insurance is really, it's a way to mitigate and minimize the risks that are out there. And so a lot of people get confused as to things that they should insure. And I'm going to tell you the best things for you to insure are the things that don't really happen very often, but if they do happen to you, they would be a disaster for your financial plan. They would be a disaster for you. A lot of people get too caught up with it should pay if every time you get a little fender bender with your car that it should pay it. I don't know that you want it to pay every little fender bender. You might want a pretty big deductible to keep your insurance cheap. What you want it for is for if you injure somebody and all of a sudden they have massive medical bills and they're coming after you for their medical bills, and you want the insurance to pay that. You don't want to have to pay that yourself. The deductible will seem like peanuts compared to what they're going to cost you. And so those are the things you should try to think about. And I'll cover kind of each individual insurance here very quickly. One of the big ones that I really talk about with my young professionals and my younger crowd is the loss of income and disability, because it's one absolutely nobody comes to me thinking about when they think about insurance. But it really is your greatest asset. If you're a young professional, chances are you haven't had a chance to save very much yet, unless you inherited quite a bit, which is not very many people that I know of. Chances are your biggest asset is your time. It is your ability to earn money. And without that ability to earn money, without you getting paid for your time, your whole plan kind of goes by the wayside. There's not a whole lot you can do. And if you think it won't happen to you, the statistics show it happens to about 1 in 4 of every Americans from the age 20 to 65 that they will be disabled at some point in their life for at least a year. So can you go a full year without income? Could you go a full year without saving anything for your retirement? Those are the types of questions you need to ask yourself when you're thinking about Social Security. A lot of people, another one is, well, I could do my job. I absolutely could do my job if I broke both of my legs. That is one of the most common, disability type things or injury, but it's still only about 1/5, not even 1/5, maybe about 1/6 of all of disabilities out there. Could you still do your job if you are sick and ill and you are in physical pain all hours of the day? How about if you accidentally go blind and all of a sudden, can I still work on a financial plan even though I can't see? There's going to be surely you can have the adjustment period and learn how to, live with being blind, but how long is it going to take you to get there? That is where disability insurance comes in, it comes in as a protection of your income during that time period. A lot of people think Social Security disability insurance is going to do it for them. In those cases, those big cases that I just kind of pointed out, it probably would. But I do want to point out that Social Security disability income is not as easy to get as everybody thinks it is. I have watched it time and time again where somebody believes they are disabled and they have good reason. I listen to them and I think they have good reason. They talk to Social Security and they do not get it. It's Social Security is very much a, can you do any job? Can you hand out flyers on the corner street? Can you do anything? If so, then you don't get it. It's that simple. Disability insurance is typically one of two things. Can you do a job that is equal to your education level? If you have a bachelor's degree, can you do a job that requires your bachelor's degree? Or they will do your own job, which means can you do your job? If you cannot do your job specifically, then you can collect disability insurance. Typically, most people get disability through their employer. Absolutely, if your employer offers it, I highly recommend that you go ahead. If they pay for it themselves, wonderful. If they don't, that's the first place I would look. You can totally go find it elsewhere. Typically, when you're talking this type of insurance, they're going to cover anywhere from 60, usually through your employer, it's going to be 60% of your income. Otherwise, you might be able to get it up to 80. A lot of that depends on whether it's after tax or before tax, which just means your employer often, if they don't make you pay taxes on it when they're paying for it, when they're paying the premiums, paying for the insurance, that means when you get the benefits, those will be taxed, which means it's going to cut into how much you're getting. A lot of the smarter employers have figured that out. And so they are no longer, they're making sure it gets taxed when they pay it. That way later on, it's not taxed when you receive the benefit. And that helps out a little bit. There's short-term and long-term disability. I'm talking more about long-term disability at the moment. Short-term disability, absolutely, if you feel like you couldn't survive until the long-term disability kicks in, usually it's about 90 days at least before long-term disability would kick in. If you don't think you could survive those 90 days, you might want to look at short-term disability as well. But definitely I would recommend looking at long-term disability and protecting that asset that you have, because it is a lot more common than people give it credit. And it is a pretty substantial loss if it happens to you. Loss of spousal contributions. And so this is where I kind of talk about life insurance a little bit. And I want to kind of picture with me a timeline of being young and single, no children, no worries. Do you really need life insurance at that point in your life? Kind of the answer is kind of yes and no. You might want to have life insurance to make sure that you can get coverage. You might want to have life insurance just to make sure whoever you're leaving behind, if it's your parents, that they have the money to bury you, that you're not a burden on them. But otherwise, not necessarily. You don't have anybody really dependent on you at this point in your life. Where it starts to come into effect is, okay, now you're late 20s, you get married. Now you have a spouse that might be dependent on your ability to earn income. They're dependent on you as you're dependent on them to be able to pay. If you have a mortgage, is very common. If you have childcare, you're starting to have children in your life. If you lose your spouse, even if they're a stay-at-home parent, now all of a sudden you have to pay for childcare. And you've never had to pay for that before. And so life insurance helps protect the person that survives, the child. And so usually you want to have some kind of insurance, especially if you have children and a mortgage, to make sure that you're covered in the event that one of your spouses dies. It's very common if you are a young professional or you work for somebody that they would have group insurance that they pay for. A lot of times that's not going to be enough. They're only going to cover, oftentimes it's one-time salary. So however much you make in a year, usually you need more like 7 to 10 years worth of insurance. 1 year is probably not going to do it if you have people like a spouse and a child that is dependent on you. You can do additional supplemental insurance. The one issue I see with getting all of your insurance through your employer is if you also lose your job, then all of a sudden you're uncovered. That often doesn't go with you. And so I highly recommend term insurance. The term is basically they designate a period. It could be 5 years, 10 years, 20 years, 30 years of coverage. And so if you're 30, you get 30 years. That'll cover you until you're 60. But I want to point out, as you're going through your timeline, as you start to get your mortgage paid off and your children leave home, they go through college, they survive college, and now all of a sudden it's just you and your wife. You know you've got retirement covered. the closer you get to retirement and you're sure that retirement's set, your need for life insurance kind of goes away. If you're retired and everything's taken care of, you don't necessarily need insurance for the standard reason. There are other reasons, and I'll talk about it later, but your need for life insurance kind of goes away at that point, and it's not necessary anymore for you to necessarily have it. And so trying to get covered until you are retired, that 30-year policy, maybe it's a 20-year policy. I've seen people do what they call a laddered policy, where we have a 20-year policy, and then in 5 years we buy another 20-year policy, so that it steps up as they need it, and then it steps back down as they don't need it. Cash-based life insurance. So this is another one, if you've ever talked to an insurance agent, especially the high pressure sales ones, that they know they're going to get a big cut by selling the insurance to you. Cash value is quite a bit different than term. Term is just pure life insurance. It is priced as cheap as they can get it for the amount of coverage you have for the age you are. Cash value is different. They call it permanent insurance. It's designed to try to last your entire lifetime. It also has on the side a cash value that slowly accumulates. And depending on this type of cash value, it might be included in your insurance benefits. Oftentimes it's not. You either get the cash value or you get the life insurance. And so saying that it's oftentimes they'll claim it's a retirement savings, and it can be if it's designed properly, but most oftentimes it's not. Most oftentimes it's not designed very well, and you're just paying for a really expensive method. I highly recommend, if you need retirement savings, that you stick to your 401k, your IRAs, things like that, and buy term insurance. It's a much cheaper, more efficient method to buy insurance in a pure method. I'm not saying that there's never a case where you wouldn't buy cash value life insurance, and we're going to talk a little bit later about one of those cases, but know what you're getting into. Most people just don't have a use for it anymore like they used to. Loss of a child. Whether or not you should cover your child with life insurance is kind of up to you. Oftentimes it gets sold as making sure that they have coverage with life insurance. My daughter was born with cystic fibrosis, so I'm not exactly sure how coverable she is, just because her life expectancy is not as long as the normal child. And so oftentimes they recommend getting your child some life insurance as a base, just so they have something. I don't know that that's necessary completely. It's more, could you cover the cost of basically bearing your child? Could you pay for the end of life expenses that come with that? And something to think about with end of life expenses, it's not just about that. I can tell you as a parent, I would be pretty distraught if something happened to my child where we're doing end of life care. I probably am going to take off substantial time from work and go on vacations, and I'm going to be spending a lot of money. So having an insurance policy on my child might not be a bad idea, just so I can do those things and not feel like I have to be at work when I don't want to be. The last little note here is AD&D insurance is accidental dismemberment and death insurance. A lot of people are going to talk about that as being life insurance. It's very similar, but it's not a reliable style of insurance to include with life insurance calculations. If you go to a financial planner and they calculate how much life insurance they need, we are just going to exclude the AD&D insurance, because you pretty much have to die in specific ways before it ever pays out. I have seen them pay out, but it's few and far between. The reason you might get it is it's extraordinarily cheap, because it never pays out. It's not never, but very rarely pays out. And so that's why it is extremely cheap. So whether you get it or not, it's totally up to you. It's just, we don't include it in the life insurance conversation. It's just, if it's offered really cheap at your work, go ahead and do it. If not, then I wouldn't worry about it at all. Loss to others, property and casualty limits. That's going to include your home, your rentals, your autos. We already kind of talked about it a little bit. As it's very important from the understanding of injury to others. And I don't want to totally discredit, needing repairs on your vehicle. If you drive a very nice vehicle, there's always risk. I've seen a local story where a cop actually had basically flew through an interchange and swerved a few times in a small Iowa town and hit one of the most expensive cars, and it made the local news because they just happened to hit one of the most expensive cars in the entire town. And then the police station was trying to figure out how they were going to pay for the repairs. So it's one of those things where you can't always control where the accidents happen. But the big focus I always try to focus on with your home and the auto are injuries to others, because health expenses are where it can add up very quickly and very much so. Home, it's generally, I think, 500,000 in kind of liability that you probably should have. So if somebody slips outside, or if you have a trampoline or a swimming pool or something, anything that crazy happens, they don't even necessarily have to sue you if they're on your property and they report it to insurance. Usually it's your homeowner's insurance that's going to cover that. Auto insurance is one that I really recommend that you pay attention to, because I've seen all too often where people are just undercovered. You go get quotes from the auto insurance industry, and their whole goal is to try to have the cheapest quote possible. They just want to be the cheapest on the market. And so they sell you this 50-100 policy, which basically what those two numbers mean. The first number is each person. If you hit a van full of people, it's going to cover $250 per person in that van of medical expenses. The 500, that's 500,000. That's for the accident. So as you can see, that's only going to cover two. If you have two people at 250, if you have three, the third person isn't going to be covered. It's because it's per accident. And so there's limits on how much the auto insurance covers. But if you ever get sold a policy that says 50-100 for those, you are vastly undercovered. And I highly recommend that you try to find somebody that would talk to you about a policy at least of this size. I have seen if you've added an umbrella insurance, usually you have to have this type of coverage to get an umbrella. But I've seen some companies will do 100, 300, and then allow you to add the $1 million umbrella. The umbrella comes over the top of your home and auto. And that's, so if you picture the umbrella, it's basically liability insurance over the top of the home and auto. And what that means is say you hit the van full of children, there's 4 kids and an adult. So 5 people, they all have expenses of 300,000. That umbrella insurance, when the 250 per person cuts out, the umbrella insurance is going to kick in. When the 500 total per accident stops after 2 people, basically, the umbrella policy kicks in. How often does something like this happen? I don't know that it happens that often, but again, it's something that would be absolutely catastrophic. Umbrella insurance is usually pretty cheap compared to most insurances because they've got insurance that kind of is there in front of it. But it's there to keep you away from the disaster. It used to be the rule of thumb was whatever your net worth is, that's how much umbrella insurance you should have, was the old rule. So if you have a $1 million net worth, you should have $1 million umbrella policy. 2 million, $2 million policy. People that have under $1 million in net worth, here's the new issue, as we've officially started to see it, where, okay, you don't have $1 million net worth for person that got injured to come sue you for. So now what they're doing is they are taking your income. They're stipending your check. They are pulling it directly out of your income. Now we talked about your income being your greatest asset. If your income is your greatest asset, they essentially can come after it too. And so I almost always recommend the umbrella insurance as well, if you can afford it. Otherwise, at least try to get up to that 250, 500. That is always my recommendation to pretty much everybody. As far as just covering your car, like I said, as long as you can cover to fix your car, it's up to you how much coverage you actually get. So if you only have $100,000 on property damage for cars out on the road, you probably know your area better than I do. If you're in a rural area where everybody drives old used cars, it's probably not as big of a deal to have a lot of coverage for hitting a car. But if you live somewhere where everybody's driving just you see Ferraris and Mustangs and Lamborghinis and things like that. If you happen to live in one of those neighborhoods, then you might want a little bit more coverage. If you live in one of those neighborhoods, I guess maybe you have more money to be able to afford it. But again, those are some things to think about. Health insurance, I'm going to just briefly cover. I know health insurance is just kind of a crazy thing for everybody. It's just getting very expensive. Health insurance is a good example of what I said before, where everybody gets so focused on covering the day-to-day things, and those are bad things to kind of cover. So covering every doctor visit, it's just kind of a bad thing to cover. It's because those are high, and if you are having the insurance company cover it, I promise they're going to raise your premium so high that you can't afford them. And that's just the problem that the health insurance industry has just had, and that's why health insurance is just not able to price it in a way that's affordable. Is because people are using it. People get sick. People want to use it. People need it. My standpoint is I believe you should at least have some insurance. So even a high deductible plan. So even if it doesn't cover every doctor visit, you can still generally, every plan, no matter the high deductible, usually you're allowed at least the annual visit every year to get a checkup, make sure you're healthy. I highly recommend you do that. I care very much a great deal about everybody's health, that they're taking care of themselves that I work with. And usually that doesn't even come out of your deductible. But after that, having a high deductible plan, obviously I have a daughter with cystic fibrosis. I am very glad that I don't have a high deductible plan, because I don't know how much of her medical insurance, that her medical expenses we could cover otherwise. We just happen to be lucky that my wife works for the local hospital and university, and we had really good insurance through them. If you're not in that case, again, you want to cover to make sure that if you get sick, or you have a child that gets sick with something like cystic fibrosis, that it's not totally going to destroy your ability to retire, that it doesn't destroy all of your lifetime goals, that you or your child is so sick that you can't do anything that you wanted to do. Having some kind of insurance in place to make sure that you are covered for that extreme scenario, I think is important. And the key number to pay attention to if you do something like that, even with any medical insurance, always watch for the max out of pocket number. Max out of pocket means, so you've already done your deductible, the insurance kicks in, but then they usually have co-pays and things like that. Max out of pocket means here's the most you will spend in a single year. If you have astronomical expenses, it's the most you will ever spend in a single year. And so each year that number is new, and each year you've got to re-spend all that money. But you can see how it's important to make sure you don't let that number get really high, because that's the type of thing that you could see break you. You want to make sure you pay attention to that number, make sure it's something that you can afford. Loss to long-term care issues. This is another one, much like the health insurance industry, they just cannot price this right. Almost anybody that needs it cannot afford it, and almost anybody that can afford it does not need it. So I cannot tell you, if you are young, please just plan for this. Plan ahead, start thinking about it long before you get there. It's not just, can I retire? It's also, can I afford the health expenses at the end of my life, including long-term care? I'm actually going to share a different screen if I can. I just have to figure out how to not share. Maybe I'm not. Oh, here we go. Can you see this, Marche? Can you see the Genworth map?
Yes.
Genworth has a really cool kind of cost of care thing out on their website. If you ever want to go see what long-term care costs in your area. I'm in Iowa, so I just happen to have Iowa clicked at the moment. I'm Coralville, Iowa City area. We actually live in one of the cheaper places in the entire country. So if this looks expensive to you, chances are it's a lot more expensive where you live. But a semi-private room in Iowa is $82,000 a year. A private room, $90,000, over $90,000 a year. I'm going to click Massachusetts just to kind of give you an idea of the ranges here. You can see a private room for long-term care, $162,000 a year. The average stay for long-term care is about 2 years. And so the question becomes is, if you need long-term care and you're early in retirement, would it totally derail everything after your stay? Would you not be able to do the things you want to do after your stay in a long-term care facility? Otherwise, the other question you have to ask with long-term care is, do I want to leave a nest egg for my children? If you're planning to leave a nest egg, then you want to plan for long-term care because you do not want long-term care expenses basically eating into that. I have to try to share again. Jump back up to long-term care. Like I said, long-term care is just one where they started pricing it years ago, and anybody that got in early, they thought that was expensive, but it ended up being a steal because everything since then, it's just gone up in price almost every year. Almost every big player in long-term care insurance has gotten out of it because basically everybody needs it. I think there's something like 60, 70% of all adults at some point are going to need long-term care. And it's just so expensive because the insurance, remember, insurance companies always have to make their profit on whatever it's costing them. And this isn't a rare thing. The best things to get covered by insurance are the things that don't happen. So in this case, if you're young, try to account for it. Try to plan on this expense. If you're a little bit older, then you probably do have to consider long-term care insurance. There's different styles of long-term care insurance. I'm not going to talk about them today, but just know that it's something that can derail a lot of things for a lot of people because most people are needing this. Trying to get away from the insurance talk. I'm sure everybody's loved to get away from insurance talk, so I'm going to jump to taxes because we all love taxes. Loss to tax on death, estate planning. This has recently become quite a bit less of an issue than what it used to be. With the latest tax bill that went through about 3 years ago or so, the inheritance tax basically doubled from what it used to be. And so each individual on a federal level can basically give up to $11.7 million of their net worth without having to pay any inheritance tax. If you're married, you get $23.4 million. So it really that kind of excluded tax planning and estate planning away from a lot of people outside of just doing your basic wills. And I strongly suggest anybody, if you don't have your basic will and things in place, make sure you do that. That's really important. If you've been putting it off, use this reminder as, oh yeah, I need to do that, and make something on your calendar so that you remember to go and do it. But I just wanted to give a very brief history because chances are it's not going to stay the way that it is. What happened was if you think about anything that you buy, you essentially, after a while, will make money on it, and it will be worth more in the future than it was worth in the past. Whether you're buying a stock, buying your home, buying a property, like I live in Iowa, so it's always family farms people talk about with inheritance tax. Whatever you paid 30 years ago, it's worth a lot more today. And so typically what they were doing was whatever you paid for it was your basis for tax, and then whatever it was worth when you sell it, you pay tax on the difference. They call that a capital gain. The problem is at death, they were forcing people to pay that capital gains. And so people were losing their family farms and losing the family business because they could not afford to pay that tax without selling part of their family farm. They couldn't afford to pay the tax and the capital gain. And so the government one time just got its bright idea, you know what, we'll give them a step up in basis. So when their family dies, whatever the value is when they inherit it, they get this huge step up in basis. So it's like all they had to do after that, anybody that had a family farm, was just keep it till they die. And then their child pays zero tax on it. No matter how big of a property they had or how much tax it would have been, they didn't pay anything. Well, eventually some different party got in there and decided, you know what, that's kind of silly. All of a sudden, we're not making any money on capital gains tax anymore because everybody's just holding everything until they die. They will never sell their stock because they just give it to their kids tax free. And so that's when they created the inheritance tax that said, basically, when you die, you're going to have to pay some kind of tax. And as you can imagine, a lot of people believe that it's essentially, I shouldn't have to pay tax, or my kids shouldn't have to pay tax because I've already paid tax when I earned it. And so it's just a constant battle. And you've just seen the inheritance tax slowly kind of getting higher and higher and higher. So it isn't really there anymore. We're still getting that step up in basis. I know back when they had the tax bill, something that was being floated around was Could they add to the basis inflation, the rate of inflation? But that, I think that just became too complicated, made taxes too complicated, so they didn't do that. But I bring all this up because I don't think they're done making changes to this. Right now, you might not have to worry about it, but in the ever-changing political landscape, at some point, somebody's going to determine that they need more money, the government, and they're going to come back after the people that are essentially avoiding a lot of tax here. And you might have to do some more estate planning in the future. If depending on what state you live in, you might have to already plan for this. I'll use Iowa as an example. We do have an inheritance tax in Iowa, but only if you send it to somebody that's not linear. And so like your parents can give it to you without having to pay inheritance tax. I could pass it to my children without paying inheritance tax, or even my grandchildren. But say I wanted to leave something to like my sister, she would have to pay the inheritance tax. She would not be free from that in Iowa. I'm thinking of states around me, Minnesota and Illinois, I both believe they have inheritance tax. It just depends on the states. Each state is different. So you want to check the rules in your own state on whether you need to plan on that part of the inheritance tax. Solutions, very briefly, I won't go into details here, but trusts are one where you kind of put everything in a trust, get it out of your control. You have somebody that oversees it, and then your beneficiaries, your children often, they're still getting it for the things they need, but it's at the discretion of whoever's in control. This is where cash value life insurance can come back into play. This was a very common thing. Parents would buy the cash value life insurance. So on the date of their death, you have this huge influx of cash from the life insurance. And that was basically used to pay the tax. The other thing is just trying to plan ahead, and there's multiple methods. If you know you're going to hit with estate tax, that you can start getting things into your children's name earlier. Different tricks that you can do. You're allowed to give, I think it's now 15,000 each. You and your wife could give 15,000 to each, your child and your child's spouse. Like it's actually an insane amount of money that you could give to your children without it even accounting for gift tax and estate planning purposes. But those are some of the things that you can do to plan ahead. Another one to think about if you are a business owner, loss to tax on the sale. If you're planning to sell your business, I highly suggest that as soon as you think you might want to sell your business, that you start talking to your CPA, and hopefully you talk to a CPA that has a valuation team as part of their overall team that knows your business and can help you drive the value up and also understand the business structure of your business. We've seen this far too often. Somebody has their business in like a C Corp or something. They sell their business without telling their CPA, and all of a sudden over half of it disappears in taxes. And it is a horrible, horrible situation. We've been in the room before when you inform them that they're about to lose half of what they just thought they made to taxes. It's not very fun. So plan ahead. If you think you are going to be selling your business, make sure you have your CPAs involved. Investment property sale. I think the important thing here is when you do these types of things, it pushes you into higher income tax brackets during the year of sale. And so it's making sure that you are accounting for those extra taxes that you're going to pay because it's giving you that higher income. Selling your house is the one kind of caveat that as long as you have your primary house and you stay in it 2 years, generally you don't have to worry as much. I believe it's like 250,000 in capital gains you can incur with selling your house before you have to worry about it. So for the most part, that's not going to affect too many people unless you just did a massive amount of work and you're talking $1 million homes, then it might be a little bit different. But most people that's selling your house isn't going to see this type of problem. Loss to tax on purchase. So kind of the reverse of that. Instead of selling something, tax on purchase. And so where that happens is typically in retirement. And so if you think about a traditional 401k or traditional IRA, you get a deduction while you're in your working years and you don't pay the tax on it. It grows tax deferred. And so then when you take it out in retirement, you're taxed at ordinary income, which means it's taxed as if it's a W-2 wage. And so having everything inside of a traditional 401k and IRA, no Roth dollars, no anything else, if that's all you have, you're going to have a base level of kind of income tax bracket, the same as you do now as you're living. Where the issue comes in is when all of a sudden you want to buy a new car in a single year and you need to make the withdrawal from the IRA. So if you make a huge withdrawal, like 30 extra thousand than what you usually are pulling out of it, that's going to jump your income up to all of a sudden, if you were in a 24% tax bracket and it jumps you up into a 30% tax bracket, it's costing you a lot more because of the tax brackets that you're in. And so it's just something to be aware of and try to plan ahead. Whether or not you should do a Roth or a traditional, chances are you should do a little bit of both. It just depends on your situation, on if you plan to have higher taxes in retirement or higher taxes now. But having a little bit of both means if I need to buy a car, I can pull from the Roth, where the Roth was taxed when you basically put the money in, the year you made the money. It grows tax-free and you get to take it out tax-free. And so if you use the Roth for your car, it's not going to shove you up in tax brackets. And so having those different accounts, those different buckets, lets you kind of play those tax games and make sure that you don't lose a massive amount of income to your taxes. Jumping away from taxes to something that I think is a lot more fun is investments. And I just want to caution on speculative investments, the investment risk. My firm, we generally do not purchase individual investments. We will talk with you about cryptocurrencies if you want, but I'm not investing your money in those things myself. If you want to, then I'm going to talk to you about how to do it without taking too much risk to your retirement. But usually I recommend that people stick with things that they understand, like mutual funds, where you're buying 500, 1,000, 10,000 stocks at once, where you're buying up the entire US stock market. The risk of owning that versus just a handful of stocks is quite a bit different. If you buy basically the entire US stock market, even if the entire stock market goes down, like in the Great Recession, you might have lost 40% of your portfolio. But if you hang on and you do not sell, that usually comes back. The US economy is probably not going away entirely. If you diversify globally, the entire globally market, it's not totally going to tank. The whole world's, if you believe me, if the entire world's economy goes in the tank, we have bigger problems at hand than your retirement. And so by owning the entire allotment of investments here, it really minimizes your risk. And that's what we're talking about with diversification. Owning just a single stock, even if it's the greatest stock in the world, it's really a risky endeavor. And the reason I say that is it's happened time and time again. Big companies, too big to fail, can go bankrupt almost overnight, and they don't come back. You know, they say just don't sell and you'll be fine. It'll come back. We've seen it time and time again where they do not come back. When you're talking individual stocks, things can happen, and even the people that are the big companies that you think are invincible, they don't end up being invincible. And it's not the risk you want to take with your retirement. You don't want to risk your livelihood on that. I'm telling you that if you think you can beat the average market, you think you can beat the stock market, they've shown time and time again that the experts cannot do it. And so I challenge anybody that thinks they've been doing it. I'm going to tell you that I believe fully that you are getting lucky, because the experts have been proven to not be able to do it. And they have entire teams of analysts kind of behind them, making sure that they are staying out of trouble. The other kind of comment here is owning stock in the business you work for. We see this so much. Your company is a great company, and oftentimes if it's a new young startup, and it's fun to get involved because you watch that stock just climb very, very quickly, and it's a lot of fun. And I've seen before where people have hung on to it, and then all of a sudden the reverse happened and started bleeding, and they think they should not sell it, and then it's all of a sudden their retirement's ruined, and it's too late by the time they realize they should have gotten out. But I really want to caution on the owning the stock in the business you work for. I'm not saying don't do it. Usually I limit it to about 10% of your portfolio if you want to do it, because you want about 90% of it somewhere a little bit more safe. The reason is you're tying essentially your current income and your future retirement to the same business having success. That business needs to have success for you to continue on working there. So you want to make sure that they're successful in that endeavor. But now you're also tying your retirement to it. It's if you think of somewhere like Enron, and I know that's kind of like the big WorldCom and Enron are like two of the disaster areas, but that's basically what happened to people. They lost their jobs. It went belly up because people were doing things they shouldn't have been doing and nobody had a clue. And they didn't just lose their jobs and their current income, but now all of a sudden they lost their retirements too. It was worthless. There was nothing they could do. And that was hugely painful because it's just a disaster. I mean, I want to talk about the sad thing for the people that ruined them. But I'm ready for any questions and anything that I can answer from anybody.
Yeah, we had a couple questions come in here. You talked a little bit about 401ks and Roth. Can you transfer your 401k into a Roth was one of the questions.
Okay, so yes and no. So 401ks can also be a Roth. You can own a Roth 401k if your employer offers it. What's interesting about a Roth 401k is even if you put in Roth dollars, like your contribution goes into a Roth, your employer is always going to match with traditional dollars. It's just the way it gets done. So if you do a Roth 401k, you're always going to have both. But as far as say you're wanting to roll it over to an IRA, typically you can only roll traditional 401ks to traditional IRAs. You can only roll Roth 401ks over to Roth IRAs. Now here's the one place where you can do it is you can do something called a Roth conversion, where you can choose to roll X amount of dollars from say your traditional IRA to your Roth IRA. Now, the thing to be aware of here is you are going to get charged tax. Remember, you got a deduction for your traditional IRA. When you made that contribution, it gave you a deduction. Or if you did it in a 401k, you got a deduction on your taxes. So if you're going to move it to a Roth, they're going to tax you when you move it. But that's definitely something you can do. Oftentimes somewhere that people will do Roth conversions, if you kind of want to get really high level here and think about it, is when you first retire, before you start pulling a lot of money out of your retirement accounts, a lot of people will do Roth conversions there because you have a few years where you don't have income. Social Security's not kicking in. And so people will do conversions and try to get their max out their tax bracket and do as many conversions as they can at that time. In a year that say you had an investment property or something and all of a sudden you had a big loss in one year and it's going to take your taxes down quite a bit, or maybe it's a year where one of your spouse decided to stay home with the kids and now you're down lower in a tax bracket, you might be able to do some conversions in those years because you jumped down in tax bracket during those years. But definitely talk to your tax expert, make sure you know what you're doing, that you don't just go transfer $2 million worth of traditional dollars into Roth IRAs. That's not what you're going to want to do because that's just going to be way too much tax in one year.
All right, we do have time for probably one or two more questions. You talked about long-term planning for long-term care in the future. So the question is that something that you save up for, like for college, or is that how should someone is maybe in their prime earning years start planning for that?
Yep. And so absolutely, it's basically just trying to save up ahead of time. And I know some long-term insurance people that are big into long-term care insurance still believe in the power of long-term care insurance. It's just, like I said, it's one of those things that's getting so expensive. It's almost easier to plan for it. So what I usually do is, and I don't know how detailed and understanding you here, but what I do is I add about 4 years worth of long-term care because I said the average stay is usually about 2 years. So I try to get a little bit extra in there to make sure we're covered. And I add that cost, that Genworth survey I showed you, I go out and wherever my client is, wherever they live, what is the year of long-term care cost for them? I'm getting really technical here, but I had the inflation rider. So what's it actually going to cost when they are in their late 70s, right? If it happens when they're 70 years old, 4 years of long-term care, what's it going to cost at that point in their life? And work back. How much extra on top of typical retirement do we need to be saving for that long-term care? So if you're just looking at retirement and you're not accounting for the long-term care cost, then you can get in trouble. And so it depends on if you have a financial planner, hopefully they're doing that for you. If you're doing it on your own, that's typically a calculation if you're using one of the free softwares that are out there, that they're just not going to be doing that. They're going to be looking at just regular retirement and can you retire someday? But absolutely, it's something that you just save for now and think about going into the future.
Well, that's about all we have time for questions. Thank you so much, Kate, for your for all you've given to us today. Lots to think about. We want to thank the organizations that have made this webinar possible today. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming. We will see you at another webinar soon. Bye, everyone.
Yeah, thanks for sticking through insurance and taxes, everyone.
There was some fun doing that. I'll talk to you later, everyone. Bye-bye.